Vinod Karki, Senior VP Equity Research at ICICI Securities. Vinod, good morning and welcome to the show, and a pleasure always to speak to you at NDTV Profit. Vinod, how are you seeing the current geopolitical situation evolve? In turn, the kind of impact it could have in terms of markets, because there is some bit of resilience which is still there. You have the FIs which are still coming in. The DIIs have continued to remain strong as well. What's the mood check looking like?
Yeah, good morning, and thanks for having me on the show. So if you just roll back, I mean, last 2 months, if you take the 2nd May as the reference point, 2 months rolling returns on in terms of USD returns for FIIs. This is probably the highest returns in the post-COVID period, almost 14% returns for FIIs on USD terms. And out of that, almost 3% odd is coming from the INR appreciation. I think from just a short-term returns perspective, the market needs to kind of cool off a bit, given the sharp rally. And the global rise in global geopolitical issues that we have been seeing gives a perfect, what you should say, a reason for the market to get into some kind of a consolidation phase after this sharp rise. I guess that's how we're looking, because even on the valuation front, the Nifty P, which had gone to reasonable levels in the recent past, has now nudged above 20 times, 20.4 to be precise. So I think we are in now for a time where the market should consolidate after this sharp rise. That's how I look at it.
Vinod, good morning. Tamanna here, and always great to speak with you. I'm wondering what are the opportunities that we're seeing here, because when you look at the Indian markets, these kind of opportunities are far and few in between. And you see that, uptick coming in fairly quickly. At this point, would you be more cautious? Would you be sitting on some cash? Or would you look at dips like we're seeing today, or perhaps in the next few days before things settle in, as opportunities to build positions?
Well, see, there are 2-3 things. One, from opportunities growth, where if you see the results so far, we went into this result season with fairly low expectations, and that's showing up. As per our analysis, the number of beats have been higher as compared to the misses. And within the companies which have shown higher than nominal GDP growth and which have kind of beaten estimates, most of them are from the cyclical sectors, while the lag, or in terms of growth as well as in terms of downgrades, we have seen more from the defensive sectors like IT and FMCG. So I think just from a growth perspective, if due to this geopolitical crisis, some of these companies which are posting good results on the industrial space, commodities, even financials, I think that will be a good opportunity, because growth is not disappointing on that front. And if this bout of geopolitical risk results in lower prices, I think that should be a good opportunity. But having said that, as I said, the FIIs have been loading up over the last several days. We have been seeing that, and 14% on a 2-3 month period in USD terms. I think that's a fairly good return in a short period of time. I think market should be in a phase of consolidation for some time before moving on to the next level.
You mentioned, Vinod, that corporate results have actually come in better than expected. That has been heartening. In terms of the kind of review that we are seeing of corporate results, what are the sectors that you think have surprised on the upside?
Yeah, so as I said, it is largely the cyclicals, be it some metals, cement, and industrials, infrastructure. Even the large banks didn't disappoint too much. So I think most of the some auto companies. I mean, this is where the results have been heartening. The growth is above nominal GDP. So energy companies, OMCs, power, and those kind of things. And where the disappointments and the growth itself. I mean, growth is subpar. I mean, the economy is growing at 10, 11% nominal GDP, and if something grows at 4, 5, 6% around that, it's obviously subpar. And on top of that, you're getting downgrades to those growth itself. We're seeing that in IT and some consumer FMCG, large FMCG companies where growth is struggling. So I think the pockets are very clear where growth is better off, basically.
So, Vinod, which are the sectors you would say is the time right to avoid? And two, if you're holding any position to exit?
Well, I think where the valuations are high and growth is disappointing, like we see in some consumer companies, where valuations are pretty high, 60, 70 P and those kind of things, and growth is coming out to be pretty low, and outlook is not also improving. I think that's the space one should be getting lighter, because there are pockets where the growth is improving and valuations are reasonable. I wouldn't say valuations are very cheap anywhere overall, except for, I guess, there are only two pockets, I think, where valuations remain quite reasonable. One is the large financial space, banks and all, and to some extent, some of the commodity companies where valuations are reasonable.
In terms, Vinod, of the core staples, banking, financials, how would you look at those right now, considering on balance the numbers have not been half bad? Would you look at a sort of a resurgence now in PSU banks, or you'd stick with the tried and tested private banks?
Well, I think, see, as long as the performance continues, and I don't think anything is extremely expensive in this space, overall financials. With some ebb and flow, they should continue to do well, I guess. And NPA cycle is still not at a space at a point where things are going to go bad from here onwards significantly. So I think it will depend on each company, and we have been seeing that there have been some differences in performance of companies, even within PSUs or this private, and that way overall. But I think overall financials are looking good, in terms of valuations to growth angle. Obviously, there is a concern on the NIM compression because of the rate cycle. But with the RBI going into accommodative, mode, which is obviously to say that it will be more concerned on, accelerating growth from here on. So I think one should be, positive on the growth aspects also going forward. Right now, there are some concerns on growth and NIM and all. But I think as the year progresses and we see a lot of these effects of these stimuluses that were done earlier, one was the whole liquidity infusion, and then the rate cuts, and then the tax effects, tax stimulus will start affecting this year, and next year we'll have the pay commission following up with on top of that. Plus the post-election capex should be good, both from the private and the government going ahead. So I think things are looking reasonably good overall for credit growth, and the accommodative stance of the RBI will ensure that rates are lower and liquidity is ample.
Right. So that's with regards to, what you should be doing in terms of the action from a market perspective. But thank you so much for joining us on the show, Vinod, and sharing your views.
Thank you.